Thank you. Hello, everyone. My name is Paula Beltran. I'm a six-year PhD student at UCLA in economics. My research areas are macroeconomics, finance, and international finance. My job market paper studies money market funds and how they provide funding for banks. I do have other work on international bank lending, and I'm thrilled to be here with this financial literacy program to share some of my knowledge. In the past, I worked at the Central Bank of Colombia as an economist, and during my PhD, I had the opportunity to work at the International Monetary Fund, at the Bank for International Settlements, and also at the New York Fed. And I'm thrilled to be here and to share some of my knowledge with you. So today we're going to talk about investing. So let me start with some of the terminology that we use. So first, an investment. What is an investment? Is an asset or an item that is acquired to get some income or appreciation on the valuation of the asset. So what we do is we buy an asset today, and we hold this asset, and we expect in the future to receive some revenue or income from these assets. It could be either from dividends, it could be either from or for the just valuation of the asset. For instance, we are going to talk later about the stocks, but for instance, if you have a stock in, let's say, Facebook, you could either get dividends from Facebook, right, which is they share profits, or you could also get the increase in valuation over time because Facebook becomes more valuable because, let's say, they are doing investment, research and development, and they become more valuable. So this appreciation means that you're gonna receive more. I mean, the value is increasing, therefore you own something that is valued more, and that's why you would get a profit from that. Yeah, right. Let's continue with equity and stock. So this particular investment is a security that represents ownership. So in the case of Facebook, when you own a stock, this means that you own a share of Facebook, right? And this entitles to the increase in the evaluation of your equity, but also to the dividends that are in a proportional way of the share that you hold, right? So this entitles the owner of the stock to a proportional share of the corporation's assets and profits. And a unit is called shares. And in the example of Facebook, you would own a fraction of this particular firm. There's also bonds. Bonds are different investment because it is a fixed income instrument that represents a loan that you're doing to as an investor to a borrower. This entity could be either a government, a corporation, a municipality, and in this way, it's like you're providing loanable funds for a particular institution, and with the loan, you're gonna get an interest rate, which are the payments of these bonds. And how bonds are used? Well, these are instruments used by these entities to raise funds for their operations or projects. So typically the best example are the T-bills, which are bonds issued by the federal government. There are other type of bonds, for instance, corporate bonds are issued by corporations as well. There are some corporations that raise in this way funds, right? So from the perspective of a corporation, you could either sell shares, so you have stocks, or you could raise that, right? So for many, it is easier to do one or the other, but there are key differences between the two of them. In the case of a bond, you'd have an interest rate that is fixed at the time of the contract, and then at the end of the period of the contract, you're gonna get this interest rate, right? And this is fixed. In the case of the stock, there is some risk sharing because it depends on how the firm does, right? So if you own a share of Facebook, it depends on the valuation of Facebook. It depends on how the firm did in during, let's say, the year or the quarter, that you're going to get some dividends according to Facebook's operation. You could also have own a bond that is related to Facebook, right? And in that case, you're going to get with some certainty a particular interest rate depending on the contract. There is, of course, in the case of the bond, there is, of course, some uncertainty regarding default. And many corporations can do default. And in that case, you're going to receive 0 interest rate. And this default probability is taken into account where the pricing is done. So we're going to talk about that later, but it's important to notice that a bond may have also some risk, and that is taken into account in the price. Okay, next, the next term is ETF. It is the exchange traded fund. This is a particular type of security that follows very closely a group of stocks, meaning that this is composed by some weights, or it assigns some weights to a particular group of stocks, which are determined ex ante. And then this with these weights, it tracks this group of stocks. So, for instance, as an example of an ETF are many in JP Morgan that follow the GBIM emerging countries. For instance, the GBIM EM index is a group of stocks that is composed by emerging countries bonds, typically long-term bonds, and there are ETFs that follow this index, which includes this group of bonds, right? Another example are other ETFs that follow the Standard & Poor's. I imagine many of you have heard about the S&P 500. This S&P 500 is just a group of stocks that with the main firms around the world, and then there are ETFs that follow very closely this index, meaning that it assigns some, it follows the weights in the Standard & Poor's, and an investment is done accordingly to those weights. So at the end, let's say, of the month, you're going to receive as income the valuation changes from this group of stocks according to the weights that those are assigned. And typically, the reason why you would like to invest in an ETF is because it follows typically as a group of stocks that are usually doing very well or are representative of the full industry portfolio. It is easier to do portfolio managing in this way rather than doing it by yourself, right? Because you could have, what you could do instead is, okay, select by yourself which stocks you want to own, right? and then you do the diversification of your own portfolio, but it takes time and needs a lot of knowledge, institutional knowledge, and therefore that's why you would rather use an ETF and invest in an ETF, which is already diversified. There are many types of ETFs, depending on the risk profile that you want to follow. So if you were to be more risk averse, you would prefer an ETF that includes only triple A stocks or bonds. If you are less risk averse, then you would you would follow an ETF that follows more risky firms, because of course with risk there is an increase in interest rate that you would perceive, right? So this is just examples of an ETF. It can track anything. You could have also ETFs that track commodities. For instance, there are some that track very closely oil or gold and so on. Or it could also track a diverse collection of securities. We're going to talk about the ETF later in detail. The thing is, an ETF is a bit costly. So we're going to talk about that later. If you have any questions, please let me know. Okay. The next term is dividends. I think I talked about that in the very first slide, but let's rephrase what a dividend is. Dividend is a payment that you're going to receive from a company if you own a percentage of the firm. So if you own a share in a company, let's say Facebook, you would receive a dividend that is coming from the profits of this firm. So those are dividends. To summarize, we have talked about three types of investment. Stocks, which are shares in one particular firm or corporation. Bonds, which are referred to the ownership of loanable funds to some extent. And you perceive an interest rate. Typically, we call it an IOU. And this gives you interest rate after the maturity. And ETFs, which follow a group of bonds or securities in general, or stocks. And those are the main types of investments that we're going to talk today about. Okay. So again, stock is a type of investment in which you purchase a part of the company or a share of a company, a firm. And then when you buy a stock or a share of one company, you're thinking about the two things: the dividends that you're going to receive because of operational profit, or because just the valuation is going to go up. So if you think about buying a stock, you like this stock or this share to be more valuable in the future. So if you believe that for some reason this firm is doing research and development that in the future it's gonna have a lot of success, you think that in the future this is going to be more valuable, right? So this means that the price per share is going to increase. So when you purchase a stock in a company, you're thinking about in the future, what would be the price of your share, and you'd like it to be higher than the one you pay today. When you own a stock, you're called a shareholder, and shareholders perceive dividends and perceive the increase in valuation over time. About the value of the company, as I mentioned, in the future, well, it depends on how the firm is performing and the expectations on how the firm will perform in the future. So many firms do not have today do not have earnings or profits, but people believe that in the future they will do, and for that reason a share might be valuable, right? But typically what I want to say is that typically the value of a firm or the value of a stock is based on how much people is willing to pay per share, and it's determined in equilibrium of supply and demand. So the supply comes from the firm, right? So the firm sells some percentage of shares, and the demand comes from investors. If investors think that the company is going to do very well in the future, then they're going to increase the demand, right? So let's say if there are good expectations on the price of oil, an oil company would perceive an increase in valuation because people know that in the future they're going to produce something that is more valuable. So this means that the price of this firm or company is going to increase, right? Or as in the example I mentioned, if you think that in the future Facebook is going to have a huge productivity, or if you think that they're going to come up with a new technology that nobody has done before, this implies that people is going to demand more of these shares, and that increases price because there is more demand for that. So whenever you are thinking about buying a stock, you should reflect on what do you think is going to happen with the price of the stock in the future. And there are some indicators that are helpful when thinking about the valuation of the firm, and also how sound are their finances. We're going to talk about that in a second, but let's do an example of the stock. So here we have an example using Apple. Apple has 1 million shares outstanding, selling at $1 per stock or per share. What this means is that the company is worth 1 million because it has 1 million shares, and they're selling it by $1 each, right? So 1 million times 1, it's $1 million. You'd think that the company is gonna do very well, and the value of this company is gonna increase, and then you buy 50K shares of the company. At the price of today, you're gonna buy this for $1, so you're gonna have to pay 50K. Tomorrow, you see that Apple is now valued at 10 million. This means that, remember, you had 50K shares that were valued at $1 before. It cost you 50K. Now, given that the price of Apple is increasing by 10 times, this means that what you had before is now 10 times more valuable than it was yesterday. This means that your 50K shares are now worth 10 times 50K, right? Then if you decide to sell your shares, you'd receive the profit, which is 10 times 50K, and then you subtract the cost, and that would be your overall profits of this operation, right? This is the case where there are no dividends, which is the case where your profits come from mainly valuation increases. Notice that what is happening here is you were buying at $1 per share. Over time, tomorrow, the price increased at a rate of 10 times, and then you're going to perceive an increase in your profits because of that. There are other profits coming from dividends. And this is suppose the same situation, but now Apple is cashing out dividends. Cashing out means that they're going to give their shareholders a share of the profits that they earn. So in this case, Apple pays out cash dividends of 0.1 per share at the end of every quarter. Then this means that you are going to receive $0.1 per share without resorting to selling. You're going to perceive these profits. How much would you get? Well, if you have 50K shares, you'd receive 0.1 per share. So then you would receive $5K dollars every quarter. This means that if you think about a year, you'll multiply this by 4, and then you will have 20K every year, right? And this income, or this streaming income, is just coming from dividends. Of course, when people thinking about the valuation of a firm, you take into account how much dividends are, what is the flow of money in the future, which includes both dividends and at the same time the valuation in the per share. Okay. So then, as I said, when you think about buying a stock or selling a stock, if you own one, you're going to think about what is going to happen with the price per share, right? When you would like to buy when it is rising rather than when it is falling, and how to know when a stock is falling, or when to stop and give out your shares and sell. Well, there are these signs of distress in a particular corporation. One is high debt. This means that the firm is leveraging more. What means leveraging is that they're using more debt continuously, which is a sign of financial distress and that they have to pay more in the future, right? Another sign of a stock falling is that there is decrease in profit. So if there's a firm that started with very good profits and you see that over time it has reduced, that's a sign of the firm not performing as well as they did in the past. So a decrease in profit would be a sign that the price is going to fall down, because in essence the price follows the performance of the firm, and it follows how much profits they have, right? And that's why when you go to Shark Tank, they ask directly about the profits to see if they want to invest, right? So if they have decreasing profit, this is a sign that the business is not doing very well. And this is also a sign that when you're buying a stock, you shouldn't invest in that particular firm or corporation. Another sign is less promoter holding. Another sign is low return on equity, decreasing earnings per share, and high price to earnings ratio. The latest 3 of them are easy to find in Bloomberg. So if you are interested and you know how to use Bloomberg, by the way, Bloomberg, you can find it at UCLA in Anderson or economics. You may be able to use Bloomberg there. You can find very easily these indicators for each corporation. These are measures of the performance of the firm, and you like a high return on equity and also a high return on assets, which means that the profits of the firm are high with respect to the value of equity. You would like also that earnings per share, you would like a stable earnings per share. If it is decreasing, this means that per share, you're receiving less dividends at the end. And a price to earnings ratio, you'd like this to be stable. Whenever the price is larger or is increasing with respect to earnings, this means that this company is probably overvalued, meaning that the price is too high compared to what they're earning. So it doesn't, it's like a sign that you'll have to sell, or I would sell in the near time. because it's just increasing the price, but there is no fundamentals increasing at the same time, right? You like earnings to increase with price. Okay. So there are risks of holding stocks, right? And I imagine you've seen this in the past in news, right? In these stocks are very sensitive to aggregate macroeconomic conditions. Stocks are very sensitive to what the business model of the firm or the corporation. It is very sensitive to potential risks for the firm. If you're, in the case I gave you before, if you're an oil company, if the price of oil, you know that in the long term it's going to decrease, you know for sure that that's a risk for this corporation, right? When there's risk, people typically start selling their stock in the company, and this is going to drive down the price. Yeah, in the example I gave, this is going to imply that demand is going to fall, and therefore price is going to fall. Here we have an example of this, which is the example of Microsoft. In the case of Microsoft, that has 1 million shares outstanding, and people buy, and it's priced at $5 per share. If you think that company will go up, you buy 10K shares. And then the next day, the price per share decreases to $1. This means that you're losing money, right? You're losing 40K just because the valuation went down. What would you do? Would you increase or buy more of the stock, or you'd sell and cut your losses? Well, I believe this depends on what are your expectations in the future on what is going to happen with the price of Microsoft, right? If you think that this is just temporary, and you believe that Microsoft in the future is going to recover and that earnings are going to increase by more, then in that case, I wouldn't sell now. But if you think that this is permanent, and if you think that, and if you are risk averse, as I am, what I would do is sell and cut my losses right away. Also, in this environments of high uncertainty, as in the case, let's say, March 2020 with COVID, people will selling very fast. And this implies that given that everyone is selling, price is going down, and then this gives incentives to other investors to sell. So this is a spiral in which price it's going to go down further. So if you are in a risky period or very certain period, such as March 2020, I would recommend selling and or go right away to something that seems less risky than stocks. So how to start investing? The step one is set up a brokerage account. I think someone else did a good job explaining how to do that. You'll need to think about where do you want to open your account, think about the fees or the costs and the implicit cost as well. Then after you set up your account, you'll need to add money to this account so you can purchase shares of stocks. And the third step, you'll do some research on potential stocks. So you'll check and do some research for each company you want to hold a share, and check the signs I mentioned before in the previous slides on where it is an increasing stock. And then in step 4, you access your bank app and trade and start buying and selling your stock. There's if you want to sell in the account, you'll have an option to do so. If you are interested in investing in stocks, this is going to take some time in terms of research and keeping track of the performance of the firm and also the macroeconomic environment in which you are. Okay, so bonds. In the previous slides, I mentioned what is a bond. So a bond means that you're making a loan to someone else. And the borrower could be either a government or a corporation. As for the government, you have the Federal Reserve, for instance, the federal government, or you can have municipalities, or you could have other governments such as let's say Colombia, Argentina, or any other sovereign bonds. Or you could have bonds from a corporation. What determines the contracts of the bonds? You would have an end date of the loan, which is, as in the case where you go to a bank, they're going to give you an interest rate and when you have to pay and when it ends, right? It's the same thing as and it's as simple as that. You have an end date, and we call the end date a maturity. So bonds with long maturity, those are typically more risky because you're going to perceive your interest rate from today to 10 years, let's say. So for instance, the T-bills, you'd have T-bills with maturity between 1 year, 2 years, 3 years, 10 years. And the same for, let's say, Colombian sovereign bonds, you'd have those tranches in maturity. There are some tranches where they are more liquid. This means that it's easier to sell and buy. Typically for government bonds, which are more liquid, are those in the middle of the curve, some between 3 and 5 years. Those are very liquid. Long-term bonds are less liquid than those that are short-term. Okay, so that's for the maturity. Second, the original amount of the bond. This is called the principal, and this is how much you're giving to this particular borrower. And the terms of for the variable or fixed interest rate payments. So when you go to a bank to get a loan, they give you the interest rate, which could be variable and following some particular interest rate, or it could be fixed. The same thing happens with a bond. You have some interest rate payments that are either fixed today or variable and follow a particular interest rate. Again, bonds are units of corporate debt issued by companies and securitized and tradable investments. The price is negatively correlated with interest rates. So this is very important. As a general rule, when interest rates are increasing, this means that the price is going down and the other way around. When interest rates are high, prices are going down. So you'd like to you'll see that there is this correlation between prices and interest rates just from the valuation of the bond. Okay, there's also default risk. So in the case of the stock, the risk was that the company is not performing very well in the future. That's the main risk, or that everybody wants to sell the stock. In the case of the bond, the risk is default. So if you think about the federal government, default is very unlikely, right? But if you think about corporations, defaults becomes more common. Or if you think about sovereign governments that are not US, for instance, let's say Argentina. Argentina has defaulted in the past several times. So you know that the risk is that you don't get paid, right? So this is the main risk of buying a bond. Again, who issues bonds? I said governments at any levels, meaning that you have federal governments and municipalities as well, and corporations, and they use it to get loanable funds to operate. And then if you buy a bond, you're a lender in essence. There's risk. Risk varies with the type of issuer. Some federal governments have very low risk profile because at the end they're guaranteed to some extent. Municipalities have also low risk but higher than federal government. And corporations, the risk is moderate. I would say as well that for the case of corporations, the secondary market matters a lot, and dryouts in secondary markets could be very common. So that liquidity risk can also impact the pricing of bonds. And we saw that during COVID-19. The corporate debt market was heavily disrupted during COVID-19, and therefore, and this means that corporations had a very hard time finding lenders because the market was so dried. The T-bills, though, when there is a flight to safety, people typically go to treasuries. So those are less risky to that extent. Also, in the case of municipalities, municipalities find lenders from, for instance, money market funds, and the conditions in those industries, or in the case of the money market funds industry, affect the pricing of their bonds and how much are they getting in terms of their loans and funds in general. So any situation that affects those investors, like flight to safety, that affects as well municipalities heavily. And it happened during COVID-19 in March 2020. Okay, the rating of the bonds. It depends on the credit quality of the borrower or the issuer. Because of course, rating determines how good they are, and if you're gonna, and if they're very valuable to some extent. And default means that you're not gonna get paid. So the rating depends on those considerations and determine the pricing of the bond. Typically, those that have lower default rates, or those are with higher rating and better prices. So it depends on the credit quality of the issuer and borrower. So let's say that you have Argentina's sovereign bonds and you have US T-bills. The credit quality for sure is going to be better for the US than Argentina's, right? So those bonds, the T-bills are going to get better credit quality and better ratings. It also depends on the length of the time until the bond matures, or maturity. When maturity is longer, those typically have lower rating. So maturity affects a rating of the bond. Having long maturity is worse for ratings. And the interest rate of the bond also affects the rating of the bond. Okay. So rating scales. So the better are the AAA, which are prime bond, which means that there is very low risk. High grade bonds are AA or AA+ to AA- in the Standard & Poor's rating. Upper medium grade bond or A or A to A minus, which are considered also low risk. And then you have medium grade bonds, which are a B, AA, or a triple B, and these are considered medium risk. There are other ratings which are worth. If you were to invest in bonds, I would recommend you to invest in those that are better quality or have a very low risk profile. So here we have three types of bonds. Issued by companies, which are corporate bonds. This means that you are a lender for a particular company. Municipal bonds are issued by state or local governments. So let's say the state of California or any other local governments. And government bonds, which are issued by the federal government in the case of the US, or sovereigns such as Argentina, Colombia, and other countries. How to buy a bond? You can buy from a broker. So you buy bonds online from an online broker. You could also buy through an ETF. I'm gonna explain this later, but in essence, remember I told you there are some JP Morgan ETFs that follow the GBI-EM. This means that this GBI-EM is an index that includes sovereign bonds from emerging countries, and they have some weights according to the market value. So you could buy an ETF that follows this index, which means that you're buying bonds from this set of countries, right? Or you could buy directly from the US government, for instance. Okay. When to buy bonds? So you like to do it when you are in a good economic cycle. Do research on the bonds you want to buy. Check out the maturity, check out the rating, check out the interest rate and the face value. And it depends on your risk profile you want to hold. Of course, if you are very risk averse, as I am, you'd like to buy bonds that have low rates, but that have very low default risk and very low liquidity risk. If you are more less risk averse, you'd like to buy bonds with longer maturity and higher interest rates. So here we have an example. So the federal government is issuing bonds for a new interstate highway construction project. Each bond has a face value of $1K with that 8% coupon rate and a maturity date for 10 years. The bond is rated at AAA+. What this information means? This means that if you hold a bond from today up to the next 10 years, you're gonna get this money back, the face value, and you're gonna receive an 8% interest rate at coupon rate, which is $80, because 8% of 1K is $80. This is the interest rate you're gonna receive from the government. AAA+ means that this is a bond with a very good profile in terms of risk, which means that it has very low risk of investment. So why would you like to buy a bond? Well, for instance, the federal bonds or the T-bills, they're typically safe and they do have very low liquidity risk. Because everybody, when there comes an uncertainty shock, people would like to hold to those, and investors would go to those safe assets. So the T-bills are considered the safe assets by excellence. They do provide some safety, and therefore that's something you would like. It also is, in terms of interest rate, it is fairly constant over time, and it is a regular source of income because it's fixed income instrument. And then if you wait until the maturity, you get high returns usually. And the cons, then do you understand that them less than cash deposits? Cash deposits just you go to a bank and set an account. The interest rate though is a bit higher. Risk levels vary, and you should be aware of that when you buy a bond. There's some times where some bonds are AAA, and it turns out that they were not. We saw that during the global financial crisis in 2008, where some securities were valued or rated at AAA, and they ended up being not as good as the rating said. So be aware of that as well. And you need to do a careful selection, especially if you're in uncertain times, as we are today. Let's go to ETFs. So again, an ETF is follows a group of securities or stocks, and this means that this is a bundle of stocks with some weights depending on the market value. For an example of an ETF is the SPDR, Standard Poor's 500 index. This means that they invest in a set of stocks of the top 500 companies that are in the NYSE and the NASDAQ. And then what you do is you just buy the ETF, and by doing so, you have a portfolio composed by these 500 companies, and the weights are given by market valuation. Or you could buy an ETF that follows, again, the GBIM. And by doing so, you're holding a stock, bonds, or a group of bonds to that extent. Okay, let's continue with this. Okay, so how to buy an ETF? Well, first, ETF are a bit expensive. There's a question in the chat about that specific trading app to recommend for students. I don't have a specific trading app because I'm just very risk averse. But there is plenty information online on good trading apps. If it comes to mind, I'll let you know about that particular trading app that I could recommend. Okay, so how to buy an ETF? You go to your broker app or banking app, and then select trade and select ETF and buy your ETF. You need to do research about the ETF and what are the weights and the previous performance of the ETF, potential future performance, and so on. This could be very expensive, but depending on the ETF, this could have very good return. So there is another question on the chat. Do you know if you can purchase part of an ETF, meaning fractional shares of an ETF? Do you mean like different weights in each of the stocks they have, or that compose the ETF. I don't think that will be doable. About or do you mean fractional shares, like you can buy 0.5? Yeah, thank you for the answer. I think it depends. Yes, I think it's doable though. Okay, and I think we're done with this. Let's do questions and answers. I'm going to stop sharing.
Yeah, so yeah, if anyone has any questions, feel free to, unmute yourself and ask, or you can drop it in the chat if you want to.
Yeah, go ahead.
Yeah, so I did ask the question about the fractional shares, and I think Jeffrey responded saying that Fidelity may and Vanguard doesn't. And that's actually a good segue into my question, just because I've been trying to do research for both of the, I'm deciding between like Fidelity and Vanguard. And like, obviously I don't know how much advice you can give me, but I was wondering like, what do you look for in a good brokerage? Like, how do you know what's better, what's not, and what's not? So
yeah, well, you should check out the fees that are charged, and when you can do cash out. There are some brokerage where you're not allowed to do so that often. That's important to know. So be aware of that, because you might want to have the possibility of doing that as soon as you want to. Yeah, check out the implicit fees or other costs related to the brokerage account. Sometimes these brokerage accounts, they claim to be free of fees. That is not necessarily true, and you should check out like, if there are implicit costs of having an account. Mm-hmm.
perfect. Thank you so much.
Sure. Any other questions?
Okay, well, if there's any other questions, please feel free to reach out to the GR3 office. We'll definitely get those to the professor so she can answer those.
Yeah, sure. If you have other questions and you want to email me, feel free to do so.
Got you. And I just want to thank you so much for coming here. Thank you so much for your time. And
No worries, my pleasure.
Yeah, I appreciate it.
I enjoyed. I had a
Yeah.
good time. I'm going to stop recording.
Oh, yeah. Thank you.